Hello everyone, welcome back to another video of non-discounting investment appraisal video. In the last non-discounting investment appraisal video, we talked about the payback method. And in this video, we are going to talk about another non-discounting appraisal method, which is the ARR, or the average rate of return. What the average rate of return is trying to tell you is that what is the percentage of the profit every year. The formula for the average rate of return is the number of average annual profit divided by the initial investment, and we are going to multiply this with 100%. Another way to calculate the average annual profit is simply taking the total net cash flow and divide it by the numbers of years. Now, these numbers of years represent the life of the asset. So let's just say, for example, if a laptop has an average life for, let's just say, 5 years, then the total of years will be 5. Let's have a look at the example of ARR. In this case, for the machine A, we can see the initial investment is 750,000. Every year, there are expenses for maintaining this machine of £7,500. In return, if we invest in this machine, then we will get a revenue from £150,000 up to £300,000 in year 5. Similar to the payback period, first we have to deduct the revenue from the expenses. So the year 1 will be 150,000 minus 7.5 thousand. Then this gives us 142.5 thousand. Year 2 will be 200,000 minus 7.5 thousand. Then this 192.5 thousand. Year 3, it will be 260,000 minus the expenses of 7.5 thousand. This gives us a total net cash flow of 252.5 thousand. Year 4 will be again 260,000 minus 7.5 thousand gives us 252.5 thousand. And finally, year 5 will be 500,000 minus the expenses of 7,500, then it gives us a total net cash flow of 292.5 thousand. After we fill in all of the number from this table, the next thing we need to do is to calculate the total net cash flow. The total net cash flow can be obtained by this initial investment of negative 750,000 plus 142.5 thousand in the year 1 plus 192.5 thousand in the year 2 plus 252.5 thousand in year 3 and year 4 and plus 292.5 thousand in year 5. If you add up everything from this number here, then the total will give you is a positive 382.5 thousand pounds. The next thing that we have to do to calculate the ARR is that this 382.5 thousand, we have to divide it for the number of years for the life of the asset. And in this case, since there are 5 years for this machine, then we are going to put the number 5 as the denominator. So 382.5 thousand divided by 5 will give us 76.5 thousand. This 76.5 thousand represent that the positive profit on average that we will get from investing in this machine. The step 2 for calculating the ARR is that we have to divide the average annual profit, which is in this example the 76.5 thousand, by the initial investment of 750,000. So 76.5 thousand divided by 750,000, and we are going to multiply this with 100%, and the answer will give us 10.2%. This 10.2% means that if we invest in this machine, then this machine will give us 10.2% return every year. If we are comparing two or more projects, then the higher average rate of return, or the ARR, then it means that it is a more profitable project. As you can see from the example, the advantage of the average rate of return is that it's fairly easy to calculate and it's fairly easy to obtain the required information. One of these where you can see the ARR a lot are the banks. Generally, when you save some money in your bank, the bank will tell you what is the ARR, or the interest rate that you are getting every year. Pairing the ARR of the banks, then whoever gives you a higher ARR, it means it is a more profitable investment. Now, the disadvantage of the average rate of return is that it does not take into time into the consideration, meaning the money today is equally valuable as money in the future, and we know that it is not the case. The money in 10 years will worth a lot less than money today because of the inflation rate. And since average rate of return does not take into the account of the inflation rate, then we cannot say that this is a true rate of return. Another disadvantage for the average rate of return is based on the accounting net income, or the net value, and it is not accounting for the cash flow. Sometimes it could be the problem because the net income or the book value will record as a positive figure, even though they are selling the product on credit and they might get the cash after 3 months, for example. One of the trouble with selling on credit is that, again, in this example, it would take 3 months for the business to get the cash. However, the business will require some of the cash to pay their staff and pay the utility bills, which are not allowed to wait for 3 months. By now, students should be able to understand what is ARR and how to calculate for the ARR. To end this video, I would like to leave the student with a practice question. Once again, there is a table where it tells about the initial investment and all of the expenses for the cash outflow and all of the revenue for the cash inflow. In this case, you will be required to calculate for the ARR of the machine B. And at the same time, you will have to tell me that which investment is a better investment. Is it a machine A or is it the machine B? As usual, you would like to save your answer into a PowerPoint format, submit it into the Study Smart, and this will count as your attendance. I hope this video gives you a better understanding about what is another technique for the non-discounting investment appraisal method. Thank you everyone for watching this video, and I will see you in next one.